got some really interesting stuff for you guys today. And of course, when I say I actually mean Alex from MacroOps as usual. You can see we're going over one of his reports again, but it's really interesting because it tells you why we are not close to a bear market and why the market has structurally changed to fuel higher stock prices. And like I said, we're going to use this report from Alex that comes from the MacroOps Collective. And the Collective is our premium product at MacroOps. And one of the things we used to do in the Collective were these monthly webinars. And I wanted to tell you real quick before we get into this video that we're releasing one of those webinars for free for you guys to watch. And it's a pre-recorded webinar. We already had it a while back. So there's no special time you need to log in or anything like that. Just go to this page right here, which I'll link to up above and down below in the description and comments, and throw in your name and your email, and I will send you the link to that webinar. Now this page is going to tell you all about Warren Buffett and how he became a billionaire and the drawdowns in his career. And it is very Buffett centric. I don't know, maybe a little too much Buffett. You can talk to Jose about that. But the whole point of this webinar is that we go over the three main pillars that are needed for long-term success in the market. So we talk about things like how to kill your ego, how to manage your emotions, and how to make sure you're using the right system for you. So check that out in the link up above and down below. It's a free webinar. All our Collective members really loved it, so we figured we'd release it here too. Okay, now let's get back to this market analysis and what's going on with this bull market. So the first thing we got to realize is that we're at all-time highs again. How beautiful. And at the same time, investor sentiment and positioning are extremely bearish. And you know, in all these market review videos with Alex, we talk about sentiment. And you remember the way sentiment works. If people are really bearish, that's actually good for the market because there's more money on the sidelines to come in. If people are excessively bullish, then that is bad for the market because if they're too bullish, they're probably over leveraged and all that leverage needs to wind down. And that's when you get the huge spikes lower. And as you've seen in all these previous videos, we've continued to track sentiment and seen how bearish it has stayed, no matter how high the market keeps climbing. So as Alex explains here, he says, going back through the data, I can't find a single comparable instance where equity markets were this close to all-time highs and investor sentiment and positioning were this bearish. It's a total anomaly. So let's go through the sentiment charts one more time so you can see what I'm talking about, how bearish everyone is. So according to the Bank of America Fund Manager Survey, fund managers reduced their equity exposure last month by the second largest amount ever. Largest occurred in August 2011. They now have their lowest allocation to stocks since March 2009, which is 2.1 standard deviations below the long-term average. So you can see here that the graph is telling you the percent of advisors that say they're overweight equities. Over here back in 08-09, everyone was piling out. So you see these blue bars going down. And then you see the blue bar going down again right now. Super bearish, super underweight equities. What they really do love are all the defensive plays like cash, bonds, and utilities. They hate energy, Eurozone, and industrial stocks. So once again, this is showing that investors are positioned for low growth and low rates. And according to this TD Ameritrade IMX index, retail investors have below cycle average risk exposure. So they are not leveling up, they're keeping their cash away from the market. And you can see this again in the year-over-year percentage change in margin debt, which is the lowest it's ever been outside of a bear market and recession. And you see here it's even creeping lower. No one's out on margin. No one is doing what I said before about leveraging up and buying everything like they do at the height of bull markets. And then all the long-term sentiment and positioning indicators are either bearish or neutral. And this is just a quick overview of all of them that we cover individually in each one of these videos. And I'll link to the whole list of these videos up above if you want to go into these more in depth. Consensus earnings expectations are also very low and continue to drop. Analysts are now estimating just 0.3% and 0.8% earnings growth in Q2 and Q3. And that is a very low estimate and a very low bar for these companies to clear. Again, another bearish sign. The 26-week average Z-score of stock versus bond flows recently hit its lowest point on record. So a lot more money going into bonds than stocks. Bearish movements. So what's going on? Because everyone's super pessimistic on growth, they're bearish stocks, and they're all flooding into bonds. But then somehow the stock market is at all-time highs. So Alex thinks the prices keep running higher because of simple supply and demand. So last year he actually wrote a note about the persistent bid, which is the structural supply and demand imbalance which has kept the stock market rising over the last 35 years. So he explains a bit here. So he says historically the US corporate share issuance has rarely exceeded 2%. So that means that corporations haven't been issuing many new shares. And over the last 3.5 decades, corporates have been actively reducing their share count through buybacks and M&A at an average annual rate of 2%. So they keep buying back their shares. And you know, we've talked about this before, the buybacks have really helped push prices up. So while the amount of shares in the market have been falling because of all these buybacks, the amount of money, which is cash plus credit, has been increasing. So over the last 50 years, the US's money stock has been rising at an average annual rate of 8% a year. So that means that over the last 5 decades, we've had the supply of equity shares shrinking by an average of 1 to 2% a year through the buybacks and mergers and acquisitions that we talked about. And we've had the total money supply increasing at an average rate of 8% a year. So supply is dwindling because there's less and less shares, where demand is increasing because there's more money chasing after those shares. So you have a supply-demand mismatch of about 9.5% a year when you combine those two things. And you know what the average annual return has been on the stock market over the same period? 9.5%. It lines up. So over a long enough time horizon, there are three things that drive overall stock market performance. That's net share issuance, you know, how many new shares are coming online and what the supply is of shares in the market. The next thing is the size of the money stock, which is how much money we all got in our pockets, because if there's money in our pockets, we got to invest it, right? And then number three is investor preferences between equities and bonds. So the overall money stock as measured by M2 is currently growing at about 4%. And despite all this negative sentiment, the average US household allocation of stocks is still high. So the overall money stock as measured by M2 is currently growing at about 4%. So that's telling you the supply is growing. And despite all the negative sentiment, the average US household allocation of stocks is still high. So they're preferring stocks over bonds still. And US companies are reducing the supply of their shares on the market at nearly their fastest pace in history. So the supply is coming down. And sorry, I said the M2 was supply here. It's actually demand. If people have more money, there's going to be more demand. And part of what's helping the supply of shares going down, because, you know, the corporations are buying them back, is cheap debt. We're in a low interest rate environment, right? So you can see the effect buybacks have had. This is total gross issuance of stocks minus S&P 500 buybacks. It just keeps going lower and lower year after year, less and less shares, which makes sense because buybacks keep growing. So even if everyone is bearish, prices are going to continue to climb higher. It has to do with how the markets are structured. And we're not saying this is going to last forever, because, you know, eventually investors will become bullish and they'll over leverage themselves, which will mark the beginning of the end. But for now, hopefully this gives you a better understanding of why prices keep climbing higher, which as equity investors, this is just great for us. So I hope you're taking advantage of it. And if you're not, don't feel too bad, because markets are all about the long term. And as I said before, check out this webinar because we talk about what you need to do to be successful in the long term. Remember, 3 things that you need for success in the stock market. And this is the webinar pulled straight from the collective. Tyler, who is my other partner at MacroOps, he's the one who hosts it. So just go to this link up above or down below, put in your name and email, and I will send you the link to the webinar. It's great, it's free, you might as well check it out. And if you want more videos breaking down markets like in this one, then make sure you subscribe to this channel and hit that notification bell so you get email notifications when our new videos come out. We publish a lot of videos a week, all about markets and business. So subscribe and I'll see you in the next one. Stay fallible out there. Bye.